Okay, I think we should start. It's 4 p.m. and we have a packed discussion about intangible assets today. So hello, welcome to the Dialogue Series. My name is Eric Lee and I'm the AASB Research Principal. I'll be hosting the session today. So today we're going to hear from researchers and practitioners providing some insights and perspectives about intangible assets. We will start with the presentation and then followed by a panel discussion. If you have any questions during the session, feel free to post them by using the Q&A function in the Zoom platform. We will try to answer those questions in the last perhaps 10 to 15 minutes of the session. I also like to mention that the views provided by presenters in this session are not necessarily the views of the AASB. So a quick introduction to this topic, intangible assets. As many of you would agree that it is a complex topic to talk about. The International Accounting Standards Board in its April meeting recently decided to add intangible assets to its research pipeline. And many other international standard setters, such as IFRAC and UK Endorsement Board, are also having an active project on intangible assets. The AASB in recent weeks has published a staff paper on intangible assets, focusing on the disclosures of unrecognized internally generated intangible assets. And the paper provides some thoughts on how such disclosures could be made and perhaps meet user needs. The paper is available on the AASB webpage for your feedback. In fact, this morning we had posted a link at the AASB LinkedIn, which can point you to the web page for the paper. So let me introduce our keynote speaker to start the session, Professor Baljit Sidhu from University of Sydney Business School. Baljit, would you like to share your slides when I'm introducing you?
Mm-hmm.
Yeah. Okay. Thanks, Baljit. So Baljit has more than 30 years of professional and academic experience in banking and executive education. She has held appointments at top universities in Australasia, and she has visited extensively world-leading business schools. Baljit is an active researcher. She has published widely in top-ranked international journals. She was the editor-in-chief of the Australian Journal of Management, and currently she is a joint editor-in-chief at Abacus and an associate editor of Accounting and Finance. She also contributes extensively to the accounting profession. She was a board member of the Accounting Finance Association of Australia and New Zealand, AFANS, and she currently serves on the AASB Academic Advisory Panel. So Baljit, I'm handing the session over to you.
Thank you so much, Eric. Can you hear me?
Yes.
All good?
Yep.
Thank you so much. I would like to begin by acknowledging the traditional custodians of the land from which I speak, which is Camaragal country in North Sydney, Australia. And in relation to intangibles, I would just like to acknowledge that the Indigenous peoples of Australia have for tens of thousands of years lived in the spirit of safeguarding the intangible called our environment. Moving on to reporting on intangibles, I'd like to frame this talk, my part of the talk, as a framework for the dialogue that is to ensue. So we don't have perfect answers, and we don't want to start with promulgating solutions, but we simply want to open the conversation. And in that spirit, I'm going to proceed in the following order. First, let's think about what we do know from research and empirical evidence, and consider if we have a problem. And what is the nature of that problem? Is the problem one of recognition versus disclosure in the external reporting sense? And what is the role of the accountant in that? Is it also a problem for managerial decision making? And I know we don't necessarily deal with that directly in the standard setting fora, but it is actually something we need to keep at the back of our minds as accountants. So intangibles are a big deal in many sectors, and I'll share some statistics on that. And recognition and measurement is actually a joint problem. The way I see it is mandatory or voluntary disclosure a viable alternative? Those are the questions. And in the absence of recognition, do we actually already observe voluntary disclosure, and how good is it? And in particular, I will talk very briefly about a paper that the AASB commissioned a few years ago on how Australian firms responded to AASB 138, which required them to write off internally generated intangibles. And then finally, I would hope that we finish up by better understanding some of the issues we need to grapple in thinking about whether we should have voluntary or mandatory disclosure. And broadly, they fall under the categories of the costs and benefits of mandatory disclosure and the quest for comparability. Now, the quest for comparability is mentioned in the AASB staff paper that Eric just talked about. I think we need to understand why we observe heterogeneity in voluntary disclosures. What's driving that? We also need to understand what kinds of skill sets accountants are going to need going forward if we change any of the disclosure requirements. What do we know about intangibles? I'm going to share just some charts from an outfit called Ocean Tomo that periodically publish these statistics. And if you look at the S&P 500, according to Ocean Tomo in 2020, 90% of the market value of the firms on the S&P 500 is composed of intangible assets. And how do they measure that? They basically take market cap and they deduct net tangible assets. Now, this 90% in 2020 could represent anything. It could represent goodwill, it could represent brands, patents, IP, it could represent talent and culture, it could represent processes and technology, or synergies across these. If you go to Europe, again, it's a high value of intangibles. If you go to China, to the Shanghai Shenzhen CSI 300 index, it's not as dramatic, but it's certainly material, almost half. So do we need to pay attention to this is the question. And as accountants, do we need to report on this? So what's the other thing we know? We know that recognition of internally generated intangibles is disallowed with very few exceptions, and that's the development portion of R&D costs. And what does prior research show? And this prior research is summarized in lots and lots of papers. I have a paper that is under review at the moment, and there's the AASB staff paper, and I've worked with the AASB team that produced that staff paper, and I recommend reading that paper. What we do know is that valuations of intangibles are value relevant. Now, what does that mean? All that actually means is that for the companies that have been studied in these various papers, company market value is positively correlated with recognized or simulated valuations of intangibles. That is all it means. It doesn't mean that the number on the balance sheet or the number that is disclosed is necessarily used to value the company. What it does mean is that both sets of information, the market value and the recognized value or the simulated value of the intangible, are reflecting similar information. Okay, that is all that it means. It is correlated. It's not bad news, it's good news, but it doesn't mean that one causes the other. That's my point. We also know that recognized versus disclosed items are viewed differently by the market. There could be possible reasons for this. One is investors perceive recognized amounts to be more reliable if they're in audited financial statements. It could also be because there's higher information processing costs for amounts that are disclosed but not recognized. because people need to pay more attention to figuring out if it's a reliable number. They need to figure out where the information came from. They need to figure out what analysts think about it. They need to find corroborating information. We also know from one particular study in the US that there's a pricing discount on disclosed versus recognized fair values for investment property, but not in settings with high reliability where they proxy that by external appraisals being used, and not in settings of lower information processing costs, and that's proxied by the presence of equity analysts. So where there are equity analysts present watching the company, the pricing discount goes away. So that to me is also an interesting finding, but it relates to investment property. It's not relating to intangibles like R&D or brands or goodwill. Now, information asymmetry we know is higher in environments with higher intangibles, and it's higher in environments where those intangibles have to be fully expensed. And again, evidence from the US shows that although analysts put in a lot more effort in those environments, they do make larger forecast errors for firms with higher intangibles. And they're lower for these forecast errors are lower for firms with recognized intangibles. So clearly the recognition of the intangible gives it some kind of information that is useful to analysts. There is also some evidence of firms having opportunistic motives for recognition. So this is what worries the accountants, right? That if you can't have a verification that you can rely on, then will companies be opportunistic in recognizing this number? And that gives us quite a lot of concern. So these are things that we do know. And if we don't want to recognize these numbers, then should we advocate disclosure? This is the question that is posed in the AASB staff paper. Given the problems that we face, should we require disclosure outside of the balance sheet? And here are some of the questions that I'm posing that I think some of the panelists will cover. What is the purpose of us making the disclosure? Do we need valuations on individual intangibles, or are we concerned about valuation for the company as a whole? Are we interested in better informing the market? So we're talking about external reporting, or are we also interested in managerial decision making? So for example, if you're going to spend $1 more on building a brand, then you want to know what is going to be the return on that dollar. Are you going to actually manage to increase the value of that brand? How do you measure that? Should we make it mandatory, or should we simply have guidance for voluntary disclosure? When will the benefits exceed the costs, and for whom? Who's going to incur the costs, and who's going to reap the benefits? What should be the nature of the disclosure? Should it be aggregate level disclosure? What kinds of measurement problems will we have? Will we go for point estimates, as in a balance sheet, or will we go for a range of estimates? And I'll speak to this question a bit later on. And I know that some of the panelists are thinking about, well, are we capable of doing this in a probabilistic fashion? And I know at least one panelist has some views on that. What is required to make this disclosure credible and useful? Do we have to disclose assumptions? What kinds of assumptions? Are they going to differ by industry? What level of assurance do we need? How do we get that assurance? Can we do it? Is comparability necessary or even desirable? This is a question that is raised in the AASB staff paper as well. But first, let me share very, very briefly the findings of the paper the AASB commissioned. of the impact of the AASB 138 standard on disallowing the recognition of internally generated intangibles in Australia. The research question was, how did these firms respond? And what we did was we went to look for companies that were most likely to be impacted. We looked at the materiality of the impact, and we looked at whether these companies offered alternative disclosure elsewhere in the annual report, anywhere in the annual report, not necessarily in the financial statements, on the intangibles that they had just written off. Did they say something about that? Very briefly, I have more details on this sample, but very briefly, we have 326 companies, of which we can get 269 data from Compustat on 269 of them. For 55 of these, we actually go and examine the annual reports, and we selected these if the identifiable intangibles were more than or equal to 4% of total assets, and they weren't delisted prior to AASB 138 coming in. As I say, I'm very happy to share further details on this sample. Most of the firms in the sample were from finance, insurance, or real estate, followed by mining, construction, and manufacturing. And then we had quite a good number from services and transport public utilities. If we look at the impact of AASB 138 on the ratio of identifiable intangibles to total assets, it's quite hard to see that the impact was material. You have to look further, deeper, and with more granularity. So if you look in the red box, you see the mean is not that different pre-post AASB 138, which became effective in 2005. Because it's difficult to see it at an aggregate level, we divided the sample into 30 quantiles after ranking companies on the basis of identifiable intangibles to total assets, the ratio of it in the year 2000, and we followed that ratio over time. And we chart that ratio for each of these 30 bins, and I'm going to show you two. So the first one has the highest value of identifiable intangibles to total assets. And you see the dramatic falls for some of these companies around 2005. Notice that some began to fall as early as 2001, 2002. And this is not dissimilar to other researchers who have found in Australia that some companies started to write off the internally generated intangibles before 138 came in anticipation of the standard. Quantile 29, which is the next one down in terms of materiality of intangibles, again, you see some dramatic falls just around 2005. So some of these companies were significantly affected. And if they were significantly affected, and if this information was valuable, you'd expect that they would say something about this information subsequent to derecognition or writing down. Again, in numbers, the impacts on some companies. The first panel shows you companies that told us they were derecognizing internally generated intangibles. Panel B is for companies that were reversing revaluations of internally generated intangibles. And panel C is where we couldn't separate whether they were reversals of revaluations or not. In every panel, the impact is significant. Given this, you'd expect, again, they would say something. What did we find? We find nil. No disclosure, zero, zilch, all 55 companies. After AASB 138 came in, they say nothing in their footnotes or anywhere else in the annual report about the intangibles they have written off. So why? Well, this is not understood. I don't understand why. Why do they not choose to provide summary statistics of value of those intangibles, and there was nothing stopping them from doing it. So although we know that recognized internally generated intangibles are value relevant and correlate with firm value, and despite our presumption that this led to a loss of information on the introduction of 138, we don't understand why these companies don't do anything about it. And moving on to mandated disclosure, therefore, before we mandate anything, we need to understand what's going on in this information environment. And regardless of whether it's mandatory or voluntary disclosure, the measurement problems don't go away. They will persist. Back to the questions I put to us before, the same questions. I'm going to share with you a couple of charts that illustrate the measurement problems, and I'm going to use brands as an example. And I used very well-known brands, Google, Mercedes, and McDonald's, for whom there's a lot of information out there. And you notice for Google, here I've got 3 brand valuation companies: Brand Finance, Interbrand, and Brand Z. International, very well-known brand valuation firms, highly regarded. They use different methodologies, and their valuations are quite different. So if you look at Brand Z in 2018, their value for Google is several multiples that of the valuation provided by Brand Finance. And Mercedes, likewise. And McDonald's, likewise. And for McDonald's, the trend is not the same for every one of these lines. And you ask yourself the question, well, if you wanted to use these numbers, what would you require of this data? Would you require the trend to be consistent? Would you require the changes in the trend to be consistent? Would you require a further understanding of the evaluation approach? Should the valuation approach be dependent on the intended use of the information? If you wanted to use these companies for external valuations to provide some validation, how would you do it if their values are different? What level of assurance can we provide? I mean, I think some of these questions need to be put, and we need to consider these issues. So that was the measurement problems. And I would like to share with you a little bit of information on voluntary disclosure by 2 companies that most of us would be familiar with if we have ever tasted any alcohol. Okay, so I'm going to share examples from Diageo and Treasury Wines. So Diageo is an international company that owns some of the most valuable wines in the alcohol area. And they give us in their balance sheet disclosure the brand values at fair value at acquisition. So no one's pretending these are current valuations. These are fair value allocations at acquisition, and they've owned some of these brands for a very long time. So they're not necessarily current values. But they also give us, within each category, quite a lot of information on how these brands or how these categories are doing. So here you've got organic volume movement, organic net sales movement, reported net sales movement. Within each category, they also give us information on, well, Scotch contributes 23% of their net sales across the company, and it grew by 15%. And then they break it down by brand. So Johnnie Walker net sales increased 12%, etc., etc. They do the same for vodka, and they go through each of these categories and give you more and more granular data. Elsewhere in the report, they share with us similar information by global, local, and reserve brands. And then they break it down by geographic segment. How are these brands doing in North America, Europe, Turkey, etc., etc. So they break down quite a lot of this information. is that information sufficient? And compare it with what Treasury Wines does. So this is from the balance sheet of Treasury Wines. They give us their brand names and licenses by region, ANZ, Americas and Europe. And notice their carrying amount at the end of the year is 478.2 million. And Brand Finance published a valuation for just one of their wines, Lindemans, at 896 million. Now, we don't know if they sell Lindemans just in the ANZ region or also in the Americas and also in Europe, and how much it contributes in each of those, whether this valuation of 896 should be related to the 478 for ANZ, or should it be related to the total of 825? I don't know the answer to that question because they don't tell us. But it's quite a large difference. It's just one brand. That's just one of their stable of brands. What else do they tell us? They give us further segment information on net sales and a little bit about EBIT margins and so on, but they don't do it by brand. They only do it by region. So the question in my mind is, to an analyst, is Treasury Wines telling you enough, or do you need to interrogate them more to value this company? Is Diageo telling you enough? They're obviously telling you a lot more than Treasury Wines is. Is the wine market different from the spirits market? Or can these two companies be put in the same category? And if you were setting some kind of guidelines for even voluntary disclosure, what would you like to see from these companies? And that's kind of the question that's in my mind as to, well, when we think about requiring disclosure, whether it's mandated or there's disclosure guidelines, what should we be thinking about? And then if you think about the gamut of industries we've got across the world, well, how do we handle this? And we're just here talking about brands, just one type of intangible. So this is like a massive, massive task. So what's the solution? I think we need to understand things a whole lot better. We need to understand whether we want to disclose valuations or just drivers of valuations. We need to understand proprietary costs to increase granularity before we force companies to do anything. And what is required to make any of these disclosures that we might dream up credible and useful. And is comparability necessary or desirable? And with that, I think we can learn a lot from current practice. And I would like to pass it back, Eric, to the rest of the panel for discussion.
Thanks, Baljit. There are a lot of questions there in your presentations that to solve. I don't think we can give those solutions by today.
No.
No. Yeah, but it's a great introduction to the panel discussion. So let me first introduce our panel members today and invite them to provide their insights. So let me first introduce Nicholas Cornelides from EverH Global, who is based in Singapore, and he has extensive experience in helping international entities in developing intangible asset strategies and valuing intangible assets. He is a chartered financial analyst and a chartered valuer and appraiser with over 2 decades of professional experience. He spent 16 years in equity capital markets in Paris, London, New York, and San Francisco in an array of functions from trading to institutional sales. He also had roles as corporate finance advisor and investor relations officer at Singapore in a variety of industries, including the renewable energy industry. And he has a strong academic background. He graduated from the Institutes for Political Science in Paris, France, and he was awarded the Lim Chong Ya Academic Gold Medal for his Nanyang Fellows MBA at Nanyang Technological University in Singapore. And then we have Stephen Reed, who is a partner of Deloitte's mergers and acquisition business, specializing in providing clients with valuation advice for mergers and acquisitions or other commercial purposes. Now, Stephen is a member and is the chair of the Business Valuation Specialization Committee of Chartered Accountants Australia and New Zealand. He has more than 30 years of experience in providing a broad range of advice related to M&A across different industries throughout Asia. Stephen is also an experienced educator. He is an adjunct fellow of Macquarie University. He teaches business valuation in the university's Master of Applied Finance, and he also teaches online course for chartered accountants seeking to be business valuation specialists. And the last panel member we have is Matt Tilling, who is a project director from the UK Endorsement Board. Matt is a member of CPA Australia and has had more than 20 years of wide range of professional, academic, and standard setting experience. He was the head of accounting at the University of Notre Dame in Australia and also a senior manager at BDO. He then moved to the UK to join the AASB as a director of education and technical staff. And today, Matt teaches accounting at Cambridge University and also oversees a number of projects, including the Accounting for Intangibles at the UK Endorsement Board. So welcome all panel members. So perhaps the first question I have is for Nicholas. You specialize in developing intangible asset strategies and valuing intangible assets for a variety of entities. So in your experience, are investors getting sufficient information about intangible assets from financial reports?
Thank you, and hello to everyone. This is indeed a very that's a key question, and the way you phrase it, asking are investors getting sufficient information, is particularly key, because if we're looking from the point of view of investors, they will of course use the financial standards that are published, but they will use that as the first stepping stone to most of the analytical work that they will do. And they will either use information that is disclosed by the company, the issuer, or they will triangulate with outside information. Effectively, there are two ways of conducting any kind of valuation or analytical work. One is the inside view, so you're the CFO or the CEO and you work inside and you have access to the raw data that allows you to go into the unit economics of whatever it is that you're doing. And the other one is the outside view, where you don't have access to this information, but you have to triangulate, you have to suppose, you have to make a number of assumptions, and that's very much the example around Diageo, where you are trying to piece things together. And in fact, what we've seen in the past 20 years or more has been investors finding ways to triangulate data that was not available to them directly in the disclosures. There are many examples, but credit card data was not very widely available. It now is literally instantaneous. That goes right into the valuation of companies. There are plenty of other examples. So whether it's inside or outside, investors will make their opinion, and they will make a probabilistic, and they will make a best guess as to the value of the company that they are thinking of investing into or not. And by the way, this also applies when we do work on behalf of investors looking directly into companies, and they do get access to primary data from the issuers. Even then, the data is not perfect for a number of reasons that we could revisit.
That's interesting, right? Because in the presentation that Baljit was given, she mentioned that there are many information about intangible assets are not being reported in the financial reports, and that would provide perhaps an additional cost for investors to get those information. And I guess that links to the next question is, why preparers are not providing such information in the annual reports? Is it because they are proprietary information, and that they do not want to provide the whole picture of what these intangible assets can do to the entities?
So again, there are two answers to that question. Very, very relevant question. The first is that the preparers are operating within a framework where the books need to balance. I mean, that is what you learn on the first day. An investor needs to take an educated guess on whatever he or she is investing into. The investors have to be more accepting of valuation ranges, of ambiguity, because if it's not ambiguous, then there is no variance, and if there's no variance, there's no alpha. It's as simple as that. So they are doing two different things. The preparers are doing one thing, the investors are doing another. Of course, they're using the same raw, well, the raw data, and I think that's a key. That's the first thing. The second thing is, as you allude to, is that it's like in physics, it's the observer effect. In disclosing the information, you're destroying the value of this information. Effectively, a lot of it can be triangulated or can be interpolated not only by investors but by competitors. When it comes to, for instance, a field that has had a lot of progress recently, which is, for instance, a corporate evaluation based on customer lifetime value. If you start being too granular in the disclosure of churn, of losses, of customer acquisition costs, effectively you are telegraphing your strategy and your weak points to your competitors, which itself compresses the value of your intangible asset. So there's no easy solution here. That's the observer effect.
And you mentioned about valuation of intangible assets as one of the biggest problems that we have in valuing intangible assets. And perhaps a question for you is that nowadays we have more understanding on different valuation models comparing to the past. The question is about valuation of intangible assets, whether can investors trust valuation numbers from the valuation models that you have been using in your experience?
Again, the array of intangible assets is itself in dispute, right? It is not only that, so the business valuation is one thing, but the business valuation is not necessarily the sum of all the intangible assets that have been identified. Some of the assets that are part of the business valuation, as understood by the investors, are not. Cannot be recognized. I mean, how do you do human capital? We know there's various research by Baruch Lev and other sources around the value of human capital, which encompasses a lot of things. But how would you ever recognize that unless you had indentured servants with you for a number of years? It would be difficult to imagine some kind of accounting for that kind of relationship. So there are some assets that will never make the cut of the accounting standards in terms of just identification of the asset. So you're left, and we do that all the time. We are left to assigning value to assets that cannot be included in financial statements at all, such as know-how. I mean, again, internally generated. It's very difficult to put that on the balance sheet, but it is definitely part of the valuation.
Thanks, Nicholas. So I've got a question for Stephen now. So Stephen, you're the Deloitte partner in M&A, and you have lots of experience in giving advice on M&A transactions. So in your experience, do you think the financial statements provide enough information to determine the values of intangible assets, and in turn is the value of business when you do a M&A transaction?
Yeah, thanks, Eric. Hi, everyone. I'd sort of slightly turn that question around a bit, Eric. I mean, it's not necessary to value intangible assets in order to value the whole of the business. And in fact, M&A participants are, when they're acquiring a business, are trying to determine a value for the whole of an enterprise. And whilst the value drivers of identifiable intangible assets may be helpful in understanding the overall value, it may not be necessary to understand the value of each identifiable intangible asset. And I guess normally, the need to break down the value into all the component parts would, absent some other kind of a deal, but it would normally be for an accounting or a tax purpose. And it could be for intangible assets where there is some tax drive that it's useful in a sort of a due diligence situation to try and think about the value of that asset. That that's not always in play. And, there's been some examples of the values of brands in alcohol companies. Like, brands don't get tax drive in Australia, and so there may not be any reason to drill down to that level of value. I do think, and so your question is, I think financial statements are not usually particularly helpful in determining the value of intangible assets. I guess exceptions to that, or areas where it might be different, are where assets are impaired, intangible assets are impaired, and you might be able to work some things out from impairment disclosures. But I could give you plenty of examples where I haven't been able to work out very many things from impairment disclosures. It's also where an acquisition is recent, then that may provide you with some fresher information. Although again, potentially not. I guess the variability on disclosures can be pretty wide as well. And just a sort of final point I'd make on this question is that even if there is useful information, sometimes the value of identifiable intangible assets could be volatile, and even a couple of months between a balance state and a issue of accounts could be a significant period of time. And I guess the sort of most volatile example I can think of is a mining tenement, and you could think about the impact on the value of a mining tenement if the underlying commodity doubles in price between when it was reported and when you're looking at it, or halves in price. And you can obviously imagine the volatility in that value, and therefore the usefulness or lack of usefulness of the reported numbers.
Thanks, Stephen. Matt, so you're from the UK Endorsement Board, and I'm aware that you are currently working on a research project on the intangible assets. Perhaps can you start with explaining why the UK Endorsement Board has started a research project on the intangible assets?
Sure, thanks, Eric. And of course, the usual disclaimer, the views I present today are my own. They don't necessarily represent the views of the UK Endorsement Board. It's clear there's a lot of noise around intangibles. I mean, there's major projects going on in Australia. EFRAG are undertaking a major project looking at reporting on intangibles, and this is really reflecting a wider kind of noise or perspective that is coming through to the International Accounting Standards Board. And this has been very clear in their third agenda consultation that intangibles was probably the most requested sort of area for the IASB to look at when it came to accounting standards. And we think it's important that we're part of that conversation. We want to make sure that the voice of investors and users, preparers, is heard loudly and clearly. So that's why we agree this is a very important area for standard setting to look at. It's clearly an area people want change, and we think it's important that we try and get a voice there. So that's why I think sort of at a large level.
And what have you been hearing in your jurisdiction from your stakeholders?
Yeah, so what we've sort of started off doing, we wanted to kind of get what I'd almost call a map of or a lay of the land, and so we've been undertaking quite intensive interviews with a range of stakeholders about intangibles. And one of the key questions we've been asking them, and this is a question that the board, the IASB, asked when they were looking at that agenda: what is wrong with IAS 38, with the intangible accounting standards itself? And I think what we're hearing is there's just this sense that it hasn't kept date with the changes in the economy. It was an accounting standard that really evolved in the 1970s around research and development in a very kind of industrial kind of accounting setting based around the development of research and development. And really, when you look at the standard, it is an R&D standard with some bolt-ons. And there's a real sense that it hasn't kept date with exactly what Baljit was showing us earlier on, that growth in intangibles since 1975. And effectively, that's when the intangible standard was written. And it just isn't capturing the rate of change. It isn't capturing the changes in the economy. And so people are very clear that they feel that the standard just isn't necessarily fit for purpose, 40, 50 years later in this new economic world. So that's sort of broadly what we're hearing, but it's quite hard to tie down. Everyone kind of has their own view on why this is a problem and exactly what elements of it are a problem.
Yeah, I think that's similar to what we have heard in the Australia jurisdictions, and I think IFRAG would also agree with me on this. There are so many different views on how the International Accounting Standards Board should move forward with this IAS 38. So I think, do you have any thoughts on what possible solutions that the IASB could consider?
Yeah, so I think from our research, kind of 3 views are emerging, and I won't put any weight on them because our work is very, very qualitative. So I won't sort of say where the sort of predominance is, but I think the 3 views that are emerging is kind of what I might call sort of a fiddle on the margins kind of approach. Expand the scope of IAS 38 and enhance the disclosure, capture more information about expenses. This is a big theme that's coming through to get clearer information. That would be kind of at one end. I think in the middle, there's kind of a view that maybe the IASB should look at something like they did with IFRS 15, revenue, move to a much more principle-based approach, come up with kind of a series of principle-based steps, and then some examples of how that would apply to different intangibles. A more radical view that's emerging is that really this view of tangible and intangible is an illusion. I mean, you look at the conceptual framework, assets are based on bundles of rights that give rise to economic benefits. There's no real difference between, tangibility or intangibility is irrelevant to the kind of things that we're trying to get at. And what we should actually be doing is really looking at the use to which assets are put and defining counting based on the use. So in fact, abandoning almost this concept of intangibility and tangibility, and just look at what is this knowledge being used for and in what ways. So that's it in brief. I know we're out of time. I'd love to talk longer on these things, but it gives you a taste of where we're at.
No, thanks, Matt. I think we're very interested to keep following your projects and your findings. I can see there's a Q&A question from Peter Wells, and it's a question for Matt, but I also open this question to any panel members and Baljit to contribute if you have any thoughts. The question is there a need to recognize intangibles if their value is obvious in the income statement? If their value is not obvious in the income statement, should they be recognized?
So I think, sorry, I'll kick off, Eric.
Go for it, Matt.
Okay, I'm jumping in. Sorry, but I think there's 2 sorts of arguments here. So I think there's one argument about the process of capturing information in the financial statements is a useful process. We heard from Stephen about this idea that the financial statements are out of date. There's volatility. I didn't quite say out of date, but there's this time lag. But there's this almost, one of the things we are hearing from investors is the discipline of having to report the information in the financial statements crystallizes the focus on getting those numbers right, and it forces entities to be upfront and to disclose volatility and to disclose changes, because eventually they'll get caught out. And I think the other thing is that capturing it in the balance sheet provides additional information, not just about the cost. So we're hearing a lot about, tell me how much you spent on brand, how much you spent on training. But by capturing in the balance sheet, we introduce ideas about life cycle. Are your employees turning over more quickly, and therefore you're using that asset more quickly? There's information value to be gained from the balance sheet presentation, just as there is from the income presentation.
Thanks, Matt. Nicholas, I can see you Your hand is up.
Yes, I just wanted to elaborate on what Matthew was saying, which is that in fact what we found over the past 40 years, and there's research on that, is that the information content of earnings has actually been declining as investors have been focusing on other stuff. And in fact, they've been focusing on longer term measures that include intangible asset creation, and that has really changed, and that means that investors have grown much more comfortable with the idea of accounting losses. In fact, there's this dichotomy between pure accounting losses and losses that are that reflect poor unit economics. Poor unit economics, there's nothing to do against that. That's just a bad business. But you can allow accounting losses that in fact reflect the creation and the building of intangible assets and strong competitive positions, and that has been a very, very strong discriminant between for stock performance over the long term. There's some research I'll gladly link to that, and that really goes to make the point about the strength of intangible assets, I think.
Thanks, Nicholas. Baljit and Stephen, would you like to contribute to that question? Baljit, you're on mute. Sorry, Baljit.
Thank you. To Peter's point about the use of earnings, he actually answers his own question in the question itself. When earnings are available and informative, then yes, you can value the firm based on the stream of forecast earnings. But where those earnings do not fully reflect yet the value drivers of future gains, then earnings are not as useful anymore. And you need to think about the valuation drivers rather than just the earnings stream. And I think that's pretty much what Nicholas was saying as well. Also, I think we need to pay attention to strategy, company strategy, why they're doing certain things and where the costs are going and why they're going there. And accountants are not that skilled at reflecting that. You get that from management discussion, but you don't get that so much from the accounting statements. Finally, I'll just make a quick point. If you want to value individual intangibles, why do you want to do that? First of all, is it separable? Are they separable intangibles where you think you can sell them off? Or there might be a competitive bid for them? Or are you trying to just value the firm? I mean, you've got to understand why you want to value them individually, right? A firm could have lots of intangibles. So what's important here is, well, what do you want to do with that information? And again, accountants need to learn a lot more about corporate strategy and marketing and the kinds of metrics those discipline areas are using to measure progress in the company. And that might be some new skill sets we need to learn.
Thanks, Baljit. Stephen?
Eric, yeah, I just was going to make a couple of points. One is that, financial statements are more useful, in some, we're talking generalities here, but if you could think about some company that for some reason was quite simple and had one brand, and, you can work out quite a lot then, because you're seeing the drivers for just one identifiable intangible assets. Of course, the reality is many companies have lots of layers to it, and I think Nicholas talked about this, but there's often many intangible assets and many different forms of intangible assets, and so whether you're getting and potentially on a different dimension across multiple business units and geographies and so on, and so you get a great deal of complexity there. The second point I just wanted to make is some intangible assets are much easier to value than others, like patented technology that's pre-revenue could be fantastically valuable, or and probably most likely not at all valuable, but it's still very particular to the case, and that could be for a valuer that would be a very challenging task, but maybe when you see companies that which are trading on the stock market based on the promise, I mean it may be, you sometimes see this in biotechs, right? I mean, they're going to cure cancer or whatever, and they still haven't actually got the technology approved. I mean, that the implied value of that asset could be hundreds of millions or $1 billion, but it's, you know, it's still very subjective.
Thanks, Stephen. Okay, so I'm getting a few more questions from the Q&A. I'm conscious of time, so I'm going to ask the last question, which is from Robert, who is the author of the AASB staff paper about intangible assets. And I think the question for the panel is, do any of you see merits in, as a first step, to simply mandate the current encouragement in the standards of disclosing a brief description of significant unrecognized intangible assets? As for the audience context, the standard does have a paragraph encouraging entities to disclose such information. And the question is, should this be mandated? Particularly given that a more ambitious project would be expected to take a long time, especially if it gets into definition, recognition, and measurement. And we have heard that from the panel that investors do look at those information, intangible assets information, for decision making. The question is, should this information also should be mandated into disclosures? Anyone wants to take up this question? Nicholas?
Well, let's take it the other way, which is the fact that there's been a lot of companies are now mandated to list every single risk factor that they incur, and all that has done is add hundreds of pages of boilerplate without really informative content. And I'm afraid that mandating this mandating the intangibles would be the same thing. You just add pages with no real content. I think what is interesting is for the managements to be mature enough to realize that the actual disclosure of their unit economics, of their processes, is itself, or is leads to higher valuations or more stable valuations, and that's probably a better standard to which to aspire.
Thanks, Nicholas. Any other comments from the panel?
Yeah, look, I mean, I think Nicholas raises a real issue with boilerplate. I mean, it would be interesting if it was done, you know, with the underlying intent. It would certainly be interesting to see what intangibles were unearthed and what the companies felt were those drivers of difference, perhaps between book value and market value. And it certainly would be an interesting input to the discussion if we can get at the heart of those material disclosures. And that would then become very incumbent on the auditors and on regulators to make sure that disclosure, like all disclosure conversations we're having, does actually provide valuable and useful information.
Yeah, thanks, Matthew. And for the audience, the paper is available on the AASB website, and the paper does provide some suggestions on how disclosures could be made. The staff will be very interested in your views to get some feedback on what disclosures would you like to see from entities if it was being made mandated about standards. Okay, so I sort of conscious of time, and I just want to thank all the panel members and also Baljit for the presentation today. Look, we can spend hours, days, and years on this topic and may not be coming out with a solution, but the very consensus that we have is that it is not an easy topic to talk about, and we may need time to think more further on how to resolve this intangible asset information to be provided to our users. So thank you, Baljit, Nicholas, Stephen, and Matt, for providing us your insights. Wonderful discussion. And we also want to thank Chartered Accountants Australia and New Zealand and CPA Australia for supporting the Dialogue Series. So the next Dialogue Series will be held on 17th of August. The topic will be about digital financial reporting, and the chair of AASB will be also speaking in that session. Thank you very much for your attendance, and hopefully I'll see you again. And thank you, panel members. Thank you.
Thank you.
Thank you very much.
Thank you. Bye.
Have a great afternoon.